Okay, Joel, thank you so much for joining us on the Capital Raiser show. I met you, well, actually, from my experience of working with Bakerson, they told me that I should go to your symposium and learn everything I can about multifamily syndication so that I can better align with them. The Bakersons are a multifamily investment group that you've worked with personally. But to start out, I'd really like to ask you how you got into this business, where did you start from, and how did you evolve into what you currently do?
Well, first of all, thanks for having me on your show. I've been in this business for more than 30 years, the capital raising business. Not always in real estate, part of it in venture capital, some of it in real estate, some of it running a fund. So I've done all different things inside of this same industry. But I started as a youngster. I'm a CPA by my background, and I was at Price Waterhouse as a youngster. Youngster being right out of college, 24, 25 years old. And my job, the last account I worked on was this giant real estate syndicator, which I didn't really know what it was at the time. But my job with an army of other guys was to convert the books and records of 500 partnerships into tax returns. And I had to do 4 partnership tax returns every single day, every day, 4 of them every day. And it was horrible. It was just horrible work. I hated doing the tax work, but I just loved reading the partnership agreements. And I just looked at these things and I said, this is what I want to do. I want to be a deal maker like these guys. I didn't want to do the tax work. I wanted to be a deal maker. And so I quit the firm, and sometime shortly thereafter met another guy. We found a property. We structured it the way that I had been structuring all these other deals, and we did our first deal together, and we made some money out of it. We did another deal and another deal. And in the first 4 years, we did a total of about 8 deals. We raised about $3 million. We broke every rule that there was, in terms of raising money, but we just cold called people and we asked them for money and they gave it to us. And, we just started getting some momentum, and it just sort of worked out.
Yeah, capital raising can be a dangerous business, and there's repercussions to doing it incorrectly. Tell us about what you learned, or how you found out that you were doing it incorrectly, and what you're doing now to not make the same mistakes.
Well, I mean, listen, at the time, I didn't know that I was doing anything that was incorrect. And luckily, we didn't lose any money, and luckily, we didn't have any problems. But and you only ever really have problems when money gets lost. When everything is going great, you don't need attorneys, you don't need insurance, but you still need to follow the rules. So we are doing what's called general solicitation, which is we are calling people that we did not know, and this was more than 30 years ago. I mean, we were just kids, and at some point in time, I learned that that's not what you're supposed to do. And, I stopped doing it. And as you become more successful in your careers, you start having more assets, you start having more to lose. You want to start being more careful, and you want to start being more compliant. You really want to follow the rules. So, it's a natural progression that you would follow the rules, as you go along, but probably a better idea to learn the rules before you even get started.
Absolutely. So from that first deal, where else has it taken in you? Because obviously now you're teaching a symposium.
Yeah, that's now. So for the first 4 years, we were syndicating real estate. We did a total of about 8 deals. In 1990, the market started to change. So I was doing the syndication stuff from 86 to 90. In 90, the market started changing. Interest rates were starting to go through the roof in the economy. Things were getting really scary. And so I knew that if there was some kind of an economic calamity, I would not be able to weather the storm. I didn't have the resources. In other words, if a building went vacant or something happened, I wouldn't be able to carry it. So I happened to, at that time, fall into a different kind of transaction, a venture capital transaction. A guy that I went to college with said, "Hey, listen, a friend of mine wants to learn about the stock market. Will you help him?" I said, "Yeah, have him give me a call." So he calls me and he said, "Hey, listen, I want to start buying stocks. And what do I do?" And I said, "Listen, I love stocks. I call my broker every day. I'm buying, selling all the time." And I said, "Here's what you do. Pick out a handful of stocks," or I gave him a list. And I said, "Just open the newspaper every day and look at these." And about, I don't know, maybe a week later, I get a fax And fax in 1990 was not that popular. In fact, many people didn't even have fax machines at that time. I get this fax. It had my name at the top, my stocks down the side, my particular stocks down the side, and then the prices of those particular stocks right next to them. And I get it the first day, and then I get it the second day. By the third day, I call the guy up and I said, "What is this thing? Where's it coming from?" And he said, "Just for fun, I put your stocks in the computer, and and I got it automatically, and that's what happened." And the guy was a computer genius. I mean, he's one of these really smart computer guys. And I said, "This is amazing. This is an amazing thing. I mean, my personally selected stocks. You're giving me the prices, so I could look at my 10 or 12 things. I don't have to look at 10,000 stocks in the paper." I said, "I think every investor in America would like to get a report like this. I mean, this is like a little personal newspaper." And I said, "Can you make a lot of them?" He says, "Yeah, you just string the computers together. We can make as many as you want." I said, "Oh my God, this is amazing." So I said, "Listen," I said, "I'm in the business of raising money to buy real estate, but I don't see why I couldn't raise money to do this instead. I mean, it's really not that different." So I started looking around for some money. And I was calling large companies, like companies that I thought would be interested in this kind of concept. And I ran into a lot of companies, of course, that were not interested. But then through sheer brute force, ran into a company that was especially interested in this. And we ended up getting $10 million to put into this company. Most of it was not cash. Most of it was advertising credits. But we would have used the cash to buy advertising anyway, so it didn't matter. So we went partners with this company. We retained a good amount of stock, and then we just started building out this company. I flew to Wall Street and started every week. I was in New York and was selling this service. And I went to the big brokerage firms on Wall Street and I said to them, "Hey, listen, we can put your name on the top of this report. Your clients can get this special report that has all their stocks right there, and they can get a special thing on their fax machine every day." And I'm telling you, we closed the deal on Wall Street that was so big that the investor got all their cash back in 6 months.
Wow. So, wow, it's $10 million they got back in 6 months.
Well, remember, it wasn't all cash that we got, but all the cash credits that they put in all came back in 6 months. Yeah.
That's amazing. And then from there, how did you transition into multifamily? Most of the syndications
Well,
that you've done?
so what happened was that, I ran this company and grew it all over the country. I ended up selling it to a Fortune 500 company. So I sold that company in 1995 and was doing some consulting and some other stuff. And I stayed in the venture business. I was working on a number of different kinds of companies. I got involved in sports and some other industries. And I was doing many different kinds of things. A total of probably 30 or 40 private placements that I had done over the next, many years, launching companies and taking stakes in companies. Some worked out, some didn't work out, and that's just the nature of the beast. And in 2008, I got a call from an executive at Marks and Millichap. And this executive said, "Listen, markets are crashing all around us. Brokerage activity is decreasing. We're thinking that maybe we should start buying some of our inventory instead of just brokering it. Can you help us to raise capital to buy some of this real estate, or can you at least come out to Florida and show us how it's done?" So I went out there and did what became the first event of our syndication hedge fund symposium. So that was in April 2009. We had 50 something people were at this event, and it was just overwhelmingly successful. People had never seen how Wall Street pulls back the curtain and raises its money, how the investors get paid, how the promoter gets paid. I mean, it's so superior to how the little guys do it. I mean, the little guys do it the best they can, I mean, it's how Bakerson used to do. When I first met Bruce and Jack, I mean, the guys were doing the best they could. They were putting deals together. They were doing like 400 deals a year, and they were making good money, but it was not what they deserved. And at some point in time, guys wake up and they say, "I'm really good at this. I deserve more money. I deserve to be paid better for what I'm doing than what I'm getting." And I said to Bruce, "Bruce, listen," I said, "let's look at your numbers here, man. I mean, you're paying enormous amounts out to your private money and your hard money lenders. Why don't you organize your money the way Wall Street organizes its money? You'll pay less on your capital. You'll have better cash flow. You'll have better money to yourself. You'll have better consistency. We can talk about what all those things mean, but it took a little while for Bruce to buy into it. But once he did, that guy he's taken off, as you well know. I mean, he's probably he's in our top 5 guys that just hitting home runs out of the park in their business.
Yeah, we really want to take the Bakersons to the next level as well. So we have around 250 units right now, and we want to grow it. I'm almost nervous to say the numbers because I'm not sure if the whole company, if everybody's on board with the magnitude of what we want to grow it to. But yeah, that's my job with them, is to get their presence out, their brand awareness, and but back to your stories. Since you've been working with Bruce, and since you've been doing the symposium, where have you been taking that personally in your own business, and what have you done for who are some of the other success stories that you've worked?
Well, so I have a fund myself, which actually is near the end of its useful life, so we're winding it down. Which is, you tell the investors we're going to be in it for this period of time, and at the end of that period of time, you start winding it down. So, I mean, that's, what I did is I went back into real estate, buying distressed assets. But as far as others, I mean, we've had our firm, we probably set up more syndications and funds than any other company in the country. We've had close to 1,000 people come to our symposium, and we've probably set up 150, 175. Well, I can't say we've set up all of them, but we've spawned 150, 175 syndications, which are project-based deals, and probably another 75 or 80. These we've all set up funds that have spawned into other kinds of things. So what happens is a guy like Bruce will set up one fund, then he'll set up another fund, and then he may, set up a syndication for a special reason or something else. So sometimes, one thing turns into many other things, and we've helped a lot of guys get up and running. And we have guys not only, so Bruce mostly does multifamily. We've had guys do ground up development, assisted living, student housing. I mean, we've had guys that are doing every different kind of thing. In fact, we now are talking to some guys that are working on a mega deal with a city, a Midwestern city in the opportunity zone area. So they're going to redevelop shopping centers and commercial assets, and it's about a $200 million deal, and we're setting all that up for them. So there's a lot of things that we do, and we advise companies, we help them. Sometimes we invest in these deals. Sometimes we just provide some advisement, and we help these guys to do it right. Because here's the thing: if you don't do it right, you're stuck with your arrangements for years. So you can hire the cheapest attorney. You can maybe hire no attorney and just Xerox pages out of a book, or you can copy and paste something off the internet. But the truth is, the deal pays for all your expenses anyway. You should get the best counsel. You should get the best advisement you can get, because when you do it the right way, you end up with a really solid structure that pays you dividends for years and years and years. And if you do it the wrong way, or you take a shortcut, what ends up happening is that you get stuck with something. And a lot of times guys don't make any money and they don't understand why. And it just ends up as a disaster for them. And that's not the goal, for sure.
Take me through this process, because I'm coming across a lot of people. It seems like multifamily syndication is a very hot thing in real estate right now. Somebody that has listened to enough podcasts or educated themselves enough to know that they want to do multifamily syndication, where is the process? How do they start and get involved? And what is your vision of a completely solid syndication process from?
Well, I'll tell you, first of all, it has nothing to do with syndication. First of all, it has to do with multifamily. You have to be pretty good at multifamily or better, or you'll never raise any money. Investors are not going to give money to beginners. You cannot practice with your investors' money. So if you just recently lost your job and you listen to a webinar and it says do multifamily syndication, hey, this sounds like a pretty good way to make some money. That is just not going to work for you. Investors are funny. It's sort of like doctors. Doctors practice on cadavers because they're low value targets. If they make a mistake on a cadaver, not a big deal. It's the same thing with this. Investors just don't want you practicing with their money. So you have to learn the business, however you learn the business, and then you can go out and you can begin to syndicate. So let's assume that somebody has a track record already. Part of the reason we've set up so many successful syndications and funds is because we have a requirement that people have some background in these things. There are a lot of guys that, listen, if you lose your job today and you want to go do something tomorrow, come to our seminar, pay us some money. We just don't do that. You have to qualify into our program. You have to demonstrate, because we fill up our room with guys that are very, very high quality people that know what they're doing. They're likely to be successful, because it just doesn't do any good for us. Our batting average is not enhanced by people that don't succeed. And that's really important to us. So assuming that somebody's got the background, the track record in the underlying asset, here's what happens. Number one is you have to thoroughly understand the process. And the process really involves, there's a couple sides. Everybody thinks you call up an attorney like you would say, hey, listen, I'm evicting the guy, send over the paperwork and let's be done. It's not like that. It's not like calling up and asking for a simple contract. The syndication process, you can do it very simple, but the truth is that's not probably in your interest. It may seem like it's proper right now, but a year from now, when you fully understand what you're doing, and it takes about a year to really catch on to how everything works, a year from now, you're going to wake up and go, man, these documents, I wonder if I'm allowed to do this and this and this. And you find out that you're not, because they're not built into the docs, because you didn't think of it, because of course you didn't know. And the attorney didn't put it in because you didn't tell him to. Well, that's a real shortcoming. So we do two different things. One is when we build our docs, we have an attorney and we have a business. So we have the legal side and we have the business side. The business side, I give all the business advice. Here's how you charge. Here's how you do your pricing. Here's how you collect your fees. Here's how you share your money. We give those instructions to the attorney, who then writes it down. A lot of attorneys will say, well, that's not necessary. You tell me after you've been doing this business for a year whether you think it's necessary or not, and you'll find out that the most necessary part is the business advice. You got to have the legal advice. That's mandatory. The business advice is voluntary, but let me promise you that you overlook that and you will pay for it 1,000 times over. So that's a big part. You have to understand how the pieces work together. You have to understand what's even possible for you to do. How many classes of shares can you have? Most deals have two. They have the promoter and they have the investors. That's it. Very simple. But there are more ways that people can invest money than just cash. What if somebody's got an apartment building and they say, listen, I've got this apartment building. My 3 kids hate each other. If I leave them the building in my estate plan, I know they're going to sell it and they're just going to burn up the money and they'll be deadbeat kids and all my hard work will have gone down the drain. So how about if I give you guys the apartment building and then you guys give them shares? We call that shares for heirs. And you guys just give them the money every single month so that they have the money, which is really what we want, but we want you guys to manage it by owning that building for us. So there are lots of ways that you can grow a portfolio. You're talking about Bakerson having some goals. The only way to do that is not by buying a building for cash. For example, when Google buys a company, do they wire money? No, they don't wire money. You know what they do? They open the stock register and they issue shares of stock. So we build in our funds the same exact privilege to be able to issue shares of stock and use the balance sheet of the company to buy things. There's another way that investors contribute. They can contribute through effort or services. And that's not possible to compensate the way most deals are written. So there's much more complexity. And people are saying, well, that isn't necessary. I'll never need that. You will need it. You just don't need it right now. And so, you just don't know what you need. You don't know what you don't know. And that's kind of a normal thing. The other thing is, how does a syndicator get paid? If you miss the fees, there's a lot of ways. There's a lot of near-term, mid-term, and long-term ways that they're going to take their money. And we want to make sure that they get all those things. So you have to really understand what's possible. And you have to learn the process before you go to write it down. I guess you can just start writing it down and take your chances. But my sense is that you'd be a lot better off to take a class on how to drive a car before you practice driving the car than just jumping in and taking your chances.
Yeah, absolutely. So for the people that are interested in working with you, what makes you uniquely qualified? Tell us a little bit about your track record and how that parlays into what you do in the symposium.
Well, listen, number one, I've been in this business for over 30 years. I mean, it's what I do. I mean, I'm one of the most well-known, if not the most well-known, the most experienced, person that does this. I mean, our firm sets up more of these arrangements than probably anybody else. Uh, Courts of law call on me as an expert to testify in situations where things go wrong. So, I mean, to be able to be qualified at the level of an expert that a court of law and a series of attorneys will call you in and say, listen, this is what happened. What do you think we should do here? Or what do you think the right thing would have been to do? They ask your opinion. They want. I mean, that makes me. That puts me at a level that's kind of a high level. I've been working my whole career on becoming an expert. That's what I know. And the symposium is the environment where we share that with people who are already at a good level that want to get into the money business, with the business that I'm in, of raising capital the way Wall Street raises capital.
So tell us more about that. What is it that Wall Street does that the typical investor doesn't do?
Well, what Wall Street is really great at doing is taking an asset and chopping it up like a loaf of bread. I mean, literally, Wall Street slices assets like a loaf of bread. And then they'll say, hey, Ruben, how many slices do you want? I'll have 3 slices. They're 25,000 each or 100,000 each or whatever the price. How many slices do you want? I want 1 slice. I want 3 slices. Those slices are called shares of stock. So Wall Street is fantastic at cutting things up into shares of stock and then letting people buy them. Earlier stage real estate people match one investor to one asset, typically speaking, because the second you put 2 people in, it creates a level of complexity that's huge. So what happens is that most people get started with one person, one asset. Hopefully they'll secure it. So they'll create a mortgage, and then they're not subject to the securities rules. Well, as soon as they take an unsecured loan, or as soon as they take more than one person, all of a sudden they start moving in this area of securities law, which is SEC and all the other stuff that people get nervous about. And they start dancing in a whole different arena. So what we help people understand is that if you really want to have a business is not matching one investor to one asset. A business is having 50 different people each put in 50 or 100 grand into your deal. And you've got all these different people, and then you do another deal and they put in more and another deal. And you have all these different clients. That's a great business. And when you've got a number of people that are supporting your transactions, and then you're going and you're doing something good with the money, you're returning them, profit, you're returning them capital, and you're doing all the things you're supposed to do. And then you're taking fees to yourself. When that happens, then you're on the right track. And that's how Wall Street does it. That's exactly what they do.
I see. Over the last 30 years, what do you think is the amount of capital in total that you've raised?
About 100 million.
About $100 million.
Yeah, of equity capital.
And so the Bakersons, Bruce told me that he raised $50 million by himself. So some of your students and the people that have worked with you are almost catching up to you. I mean, halfway. That's a pretty big deal. So,
well, hey, listen. I'm proud of Bruce. Bruce has been an all-star, and my goal is not to hold the world record of capital raising. There are many guys who've raised much more than I have, but there's different ways of raising capital. There's different ways of measuring what capital is. For the kind of capital that I've raised from accredited investors, typically $50,000 to $500,000 a person. $100 million is an awful lot of money. If you're raising institutional capital and you're raising it in the billions, then that's what it is. If you're raising private money and you're securing, those loans, then maybe it's a lot, maybe it's not. I don't know. So each person you have to measure for yourself. But I'll tell you what, it's not a contest. I'm proud of Bruce for what he's accomplished, and I know that he's not done yet.
No, he's not. I think he's just getting started, honestly. So he's been going on a lot of podcasts. We'll probably have him on this show pretty soon. Now, tell us a little bit about your favorite asset classes. What are the best types of syndications, or your personal favorite syndications that you've done?
Yeah, well, number one, there's not a best asset class. There isn't such a thing. In different economic cycles, different asset classes perform better. So you have to be sensitive to this sort of thing. We really are professional investors. The people who invest with us are not professional investors. I mean, they tend to be their limited partners. They tend to be retail investors, and they depend on us to lend our expertise and our insights. And so they're looking to us to help them do the right things. And as professional investors, we have to be sensitive to what's working at what times. I find that multifamily is a simpler asset class than a lot of other ones. It's simpler than certain other kinds of things. It's easier to finance. It's easier to explain. People need housing. It's a basic need in our economy. And so it is subject to a lot of the fluctuation that has. Now, there is a lot of legislation or regulation around housing because it's where people live, and government doesn't want you kicking people out of their house willy-nilly. But it's a stable and good asset class. As we move into this new economy, commercial is getting hammered because of the Amazon effect. I mean, there's different problems with that, but there are certain pockets where that's starting to work. Industrial space is a powerful space. We still need office space in spite of the fact that people telecommute. So you just have to look at it. And that's the reason that I really require when people come to our symposium that they bring an asset class specialization with them. I don't want somebody to come in there and say, I'm going to sit here and see what I decide to do. That doesn't work because investors don't want you practicing with their money. They need you to come to the table with an expertise, whatever that expertise is. And when you come to the table with that expertise, that's when they loosen up their wallets and they feel comfortable investing with you.
Yeah, it's really nice having a group that I can lean on that has a phenomenal track record. And some of what I'm doing is I have a marketing campaign on LinkedIn. So I'm reaching out to people and finding some accredited investors on there through my VAs. What is your impression? How do you feel about social media as a branding tool? Do you like it, or do you think it's necessary, or do you think you just need to go and ask the people directly?
Well, listen. I've got very big followings on social media. I mean, I've got one of the largest networks in the world on LinkedIn. I've got a substantial Twitter following. I've got a substantial, I'm connected on all of those, and I believe in them a lot for branding, for connecting. But I also know that you have to take those connections offline if you want to take them anywhere. And so I think I met the way I met Bruce through another guy, and I think I met that other guy through LinkedIn. But I probably reached out to the guy, had a phone call with him, had a connection with him, and then we did something together. And then I ended up meeting Bruce through that. And so I think that social media is fantastic, but you got to use it the right way. And the right way is to put the fish hook in the water, but at some point in time you have to take the fish out of the water, and you got to connect with it. And that's the reality of it, is that if you don't do it the right way, you're not going to have the level of success that you expect.
So what are you doing to grow your business right now?
Well, I speak a lot. I mean, for me, speaking is one of the ways that I do it. I'm good at that. I've got a lot to share, a lot of stories to tell, a lot of background to communicate. And so I do a lot of that. I post a lot of materials. We produce a lot of videos, a lot of educational training kind of stuff. If people want to get a hold of that stuff, they can go to syndicatefast.com. They can register twice a week. We send out videos, and people write in questions to us. This week we got several new questions, which I'll answer here pretty quick. And we just produce these little videos. People ask us questions. Hey, what's the difference in a syndication to fund? How do you do this? What's the right amount to raise? What should we do here? What should we do there? I mean, there's a lot of questions that people ask us, and we put those answers out because we're respected experts in this area.
That's amazing. Okay, so tell us about your upcoming symposium. Are you planning on doing this over and over long term, or how many do you have planned for right now?
This is our 23rd national program that's coming up here in October, and we typically do it twice a year. But I'm sort of getting a little exhausted. Twice a year is kind of a lot, so I'm thinking we may cut it back to once a year. I'll be deciding that here pretty soon. but it's we just have developed such an awesome following, such a great network of people that I really enjoy the group that we create. The camaraderie is excellent. We meet for 3 days. This upcoming one will be October 27 to 30. So Sunday night there's cocktails, and it's all day Monday, Tuesday, and part of Wednesday. And we just take a really deep dive into how the capital raising business works, where the money is, how you structure your pricing, how you get paid, how you share the money with the investors, how the investors calculate their returns, what they look at. We role play how you work with investors. I mean, all kinds of stuff that really makes it possible for people to be successful. Guys like Bruce to take what we do in the program and then go off and raise $50 million. I mean, come on, that's a pretty significant success story.
Yeah, it's crazy. Are there any secrets or any nuggets that you can share right now with the audience that you're going to be talking about in your symposium?
Well, there are some things that we've got formulas that are proprietary. Those are confidential. We don't share those out loud. And when attorneys and longtime syndicators see these formulas, they smack their forehead and they say, "Why didn't we think of this?" They've left hundreds of thousands, or maybe sometimes more, on the table, and that I won't share. But the kinds of stuff that really make the biggest difference are just pure common sense, but not common practice. And those kinds of things are, for example, making sure that you have a substantial track record. I mean, if you don't have a track record, get your track record before you go out and you raise your money. I mean, that may seem obvious, but to a lot of people, it's not. A whole other area is, you have to give investors a deal that they can say yes to. Now, this may also sound absolutely ridiculous, but who wouldn't give investors a deal they could say yes to? But I will tell you that most attorneys write deals that are so egregiously tilted in the favor of the promoter that investors won't say yes. The attorney's job is to protect the client. The client is the promoter in that case, the syndicator, the promoter, the fund manager, they're all the same. But they also have a little bit of responsibility to make sure that investors say yes, because it doesn't do any good to protect your client to the point where no one says yes, and they don't give you any money. And so, you have to create what are called investor-friendly terms. And investor-friendly terms are the kinds of, dealing with situations that come up that really are not critical to the promoter. For example, let's say that somebody calls you up and says, "Listen, I want to transfer my shares. I don't want to be in this investment anymore. Sorry, it's an illiquid investment. You can't get out of it." Okay, I get that. That's what I agreed to, and that's the nature of how these deals are. But my neighbor wants to buy the shares. Well, I don't particularly like when people sell their shares to their neighbors, because that creates sort of some problems. So I might say no. But let's say that the person says, "We're doing some estate planning and we want to give the shares to the grandchildren." I don't care. That's fine. Now, you might want to separate the economic interest of giving the shares to the grandchildren and the voting interest of giving the shares to the children. Maybe you don't want the grandchildren to vote in this transaction. Maybe you just want them to get the money. So, you have to really think about some of these things. Some of these things get a little bit more complicated, but I can tell you that earlier stage guys aren't thinking about this. And people are probably listening to us right now saying, you know what, that's not my problem. I don't really care about that. Just give me the money. Let me build the building or do what I want. This matters, because, when you've got people's money and people need to do things with their money, they're going to call you and they're going to ask you for things. And if you haven't organized yourself and planned ahead accordingly, this will be a less fun business than it should be. This is a great business. It's an awesome business. It's a business that has a lot of potential, but you have to make sure that you do it right, or it will not go your way.
So just to clarify, your firm does not do the estate planning side, but you guys are connected with the lawyers that when a syndicator or somebody, not a syndicator, but a limited partner in a deal wants to do those things, you direct them. You direct that traffic.
Well, it depends. We don't do estate planning. I mean, there's attorneys that do estate planning, but then they might say, "Okay, call up and reorganize your shares." Well, yeah, our attorney would help to reorganize those shares. So, but we don't write people's estate plan. No.
Yeah, the way you dress and the way that you carry yourself. I originally reached out to you thinking that you were a lawyer. I don't know if you recall that conversation, but
No,
then
I'm not a lawyer. I'm a CPA. And I've spent a lot of time with the lawyers, and remember, when I go into courts of law as an expert, and I testify and I do depositions. I got a deposition coming up here pretty quick on a situation that didn't work out very well for somebody, and they're all mad. So so there's a lawsuit, and that's what happens. That's normal. And believe it or not, some of the best stories that I have come from those lawsuits, because you can't make this stuff up. And that's the reason that you need really good docs, is the docs protect you. You have to have really good materials. And I've been on both sides of it. I've been on the side where, I've invested in deals. I've been on the side where I'm the promoter in a deal, and then I'm an expert in the deal. I mean, so, I've been on all the sides. I mean, I've been all around it. I've been doing it for a long time, and I just have a strong sense of it, how this works.
tell us a war story, something that you've learned a lot from. Maybe it happened to one of your clients or somebody that you worked with. Maybe it happened to you.
You know, there was an expert case that I worked on a couple of years ago. This was just one of the worst ones ever. I haven't personally had anything that terrible happen, because I managed to keep things under control and like that. But a lot of guys want to get a whale for an investor. They want to get a giant whale for an investor. And so these guys, this was a technology deal. They had put this technology together, and they needed a big investor to put in 20 million. So they hired like an investment bank or whatever, and they found a company that is a big hedge fund that was interested in their technology, and they were looking at doing the whole thing for 20 million. So they said, let's send over all the due diligence. Let's look at everything. And we want to see your financial records. So they want to look at everything, which is normal. They want to look at everything. And as it started kind of getting down to the wire where the company was running out of money, the hedge fund, who knew they were running out of money, and that's the thing, is that when you deal with somebody who's big, they're smarter than you, they got more money than you, they got more attorneys than you. It's totally unfair. And everybody wants these giant investors, but they don't realize that the reality that comes with them, which is not a reality that you want. Let me promise you. So the big hedge fund says they could tell they're running out of money. Listen, we can't complete the due diligence in time to give you the 20 million. So why don't we do this? Why don't we give you a little bridge? We'll give you, let's say, 3 million now, and then we'll continue to do the due diligence. And the company goes, oh my God, that would be so helpful. That would be awesome. So they drop the documents on the 3 million, and they put everything together, and they're doing all their stuff. And at the last minute, like the day that the payroll was due, I mean, this was totally calculated. The day the payroll was due, the hedge fund calls up and says, oh, there's one more paper we need you to sign. Their attorney happened to be out of town. The scientific company's attorney was out of town. And so the president of the company just signed this paper at the last second so they could get the wire of the 3 million and make their payroll. Well, it turns out that what that paper was it turned the whole thing into what was called a convertible note. So instead of it being a direct equity investment, it changed into a convertible note. And the hedge fund investor, 6 months later, when there was time for them to pull the trigger and put in the other 17 million, calls the company and says, we changed our mind. We're not going to do this investment. So why don't you just give us back the 3 million and let's just part friends? And the company's going like, part friends? Like, what do you mean give you the money back? I mean, we are counting on that 17 million. We don't have the 3 million. Now, what had the hedge fund accomplished is they got in and they had access to all their due diligence, all the scientific research, all the patents, all the information, all the trade secrets, all the everything that they needed to know that they wanted that company. So why didn't they just put in the 20 million? Because if they put in the 20 million, they would have owned let's say a 20% stake in the company. But by putting in only the 3 million, now they could foreclose on the company and get the whole thing for free. So Wow is right. So, basically this company was stolen for $3 million.
I've heard similar stories like that before, actually, believe it or not. I didn't know that you would be involved with anything to do with that. I mean, at least in terms of finding all out about it. What was your role in this, or you just?
Well, I was an expert, and the company that lost the company that got stolen, it was like They wanted me to say, did the big company do anything wrong? And what I helped them understand was that I don't know if they did anything wrong or not, but certainly they did it on purpose.
Yeah.
There were several things that they did that were calculated and on purpose. And here's, and then the attorney took that information and did whatever they did with it, that, it was calculated, whatever. But the way that you knew that it was on purpose is, if you've ever gotten a loan, you go through an underwriting process. There wasn't any underwriting. They just reorganized it from a debt offering and from an equity offering to a debt offering that was convertible and that was recapturable. And it just, it was done in a way that was crystal clear on purpose. And then they manipulated all the information that was given to them in good faith to their advantage. It was really bad faith. It was really terrible. And in this little company, they didn't have the money to defend themselves. I mean, it was really terrible for them. So, but this is the kind of stuff that happens. And what I tell people is that you just can't, run around town looking for a giant whale. You got to be very, very careful, because when you take money from somebody who's bigger, more sophisticated, richer, more lawyers, more accountants, more advisors, you put yourself into a really precarious situation. And most beginners don't understand this at all. They just want the money. And money comes at a great cost. Sometimes there's an interest factor. Sometimes it's a preferred return. And sometimes the devil moves into your house. And you got to really, really think carefully before you do it. So these are the kinds of things that we help people understand in the symposium.
Okay, so let's talk about what can people do to make themselves successful. I mean, maybe something like surrounding yourself with the right people. What do you have to say about that?
Well, listen, that goes without saying. If you're surrounded by knuckleheads, forget about it. I mean, so you got to be surrounded by good people, but that's not enough. I mean, you still have to have a little bit of technical know-how. You have to know how to do the real estate. You have to know how to do the money. You have to know how to do the asset management. You have to know how to deal with your vendors. I mean, so you have to have a team in place that you deliberately construct. You can't randomly just assume that something's going to happen. You have to deliberately construct a team that's going to work for you, that covers all the bases of all the different parts of this industry that you need to put together in order to be successful. So they got to be smart, but they also have to bring the skills in the right areas.
Do you have any tips about how somebody can form a master team like that?
Well, what they need to think about 4 major categories. Somebody on your team has to understand the real estate. Somebody on your team has to understand the money. Somebody on your team has to understand the property management or the asset management, because once you acquire the asset, the real estate person is going to acquire the asset, and then the property management side is going to take care of that asset for the next many years. And then you need a business management person that's going to kind of run the office, manage the investors, the vendors, the professional services, the tax work, all the things that need to happen. So there are 4 big categories where these things happen, and there has to be somebody on your team who knows how to do each one of those.
So when you say real estate, you're talking about the acquisitions and the underwriting.
Yeah, exactly. Somebody has to know the markets. Somebody has to know pricing, rents, and all the other stuff. And frequently that kind of person would be a broker type person.
But your specific, your symposium is more about raising capital than some of the other parts that you're talking about.
Yeah, it's we don't teach people real estate because we assume that they come to the table with some level of expertise in their category. But the part that real estate people don't know is the money. And what they really don't know, the most important thing of all, is that the money's not made in the real estate. That's not where the money comes from. The money is made in the money. And if you have the money, when you control the money, you can buy all the real estate you want and make all the money you want. So the more money you control, the more real estate you can buy. So really, what we do in the symposium is we help people understand that they're not in the real estate business, that they're in the money business. And when they go into the money business, all of a sudden, that's when when everything skyrockets for them. Because when they understand that their job is about raising money so that they then can go buy real estate, that small paradigm shift changes everything about how they think and about what they do.
Yeah, absolutely. That's why I'm interested in going to your your course, your symposium. For somebody like me that's got an all-star team already in place, what can I expect to gain from going to your symposium? Will I be able to raise capital from going to that?
Well, number one, you'll understand the rules of the game a lot better. Number two, you'll be able to understand what Bakerson's doing. I mean, you'll understand why they do the things that they do. You'll understand some of the nuances. It will make you a much better player, a much better partner on the team. That's number one. Number two, I'm not sure exactly what your role is in terms of raising capital or how you do it or what you're involved in doing, but it will absolutely help to clarify for you what you should be doing, what you shouldn't be doing, how you should be doing it, and what's going to work best for you in most of your circumstances.
Okay, so once again, your symposium is the 27th, 28th, and 29th of October in Las
Yeah,
Vegas.
actually, it's the 27th to the 30th. So it's Sunday night to Wednesday lunchtime in October. So the 27th to 30th of October in Las Vegas, coming up here in 2 months.
And how do people sign up for it? How do they get a hold of you?
Well, from here, the best thing to do would be to go to syndicatefast.com, because that's where they can get into our mailing list. They can get into our flow of information, and that way they can see our videos. Otherwise, they can text the word asset, ASSET, to the number 72,000. That's another good way for them to get into our flow, and that way they'll get our information. And once that happens, then there'll be links to sign up, or they can reach out to me directly.
Awesome. I'll make sure that they get all that information in the feed. What do you have for closing words for the audience?
Well, this is not a business for you to fool around in. I mean, this is a serious business. You'll make serious money, but it's a serious responsibility. And we make our money in two different ways. We make our money for being smart, which is what everybody in real estate does. That's the part they're already used to. In other words, if you buy something that goes up in value, you were smart. But we also make money on our time. The problem that most people have, most of our wholesaler friends and other people, is that it takes them 6 months. They go out, they make their money, and then by the time the 6 months is over, they didn't get any money during that period of time. They have to borrow a bunch of money on their credit cards. Then they get the big clump at the end. They pay out their credit cards. And now they're back to where they started. And they're on this hamster wheel, this treadmill, and they never seem to improve. The reason that the syndication business is so powerful is that you're getting fees for all the services that you render. You become the vendor of choice for your syndication or your fund. And what that means is that every time something has to happen that you know how to do, like broker the real estate, be the property manager, be the construction manager, be the GC, be the broker for the mortgage, whatever the things are that you know how to do, if you're going to hire a third party, you might as well hire you, and you can do that. So you're seeing money come in all the time on a regular and recurring kind of basis. That gives you a lot of flexibility for building out a proper staff. It also allows you to scale and to make a little bigger firm. So a wholesaler or a fix and flipper, they might be able to do, 2 or 3 projects at a time at the most. But somebody else, they might be able to do, 10 things, because now you got a whole team. You got the Bakerson's got a whole crew. Bruce has used this strategy to build out a whole crew of people, and it's really worked out for him.
Awesome. Well, thank you so much for joining us on the show. And I'll send you a link to everything that we post online. I'll tag you in a couple of places on Instagram and whatnot. And I just want to say thank you so much for your time. It's very valuable, and the audience and myself, we really appreciate it. We look forward to doing business with you. And I'll be seeing you at your symposium later in October in Las Vegas.
Hey, Ruben, thanks very much, man.
You bet. Take care. It's been a pleasure.